Welcome back to the Dividend Diplomats YouTube channel. Everyone, you got Lanny and Bird here. You know by now we're the Dividend Diplomats. We are ready to bring you another exciting news story here from the market this week.
You know the drill. Smash the subscribe button, give Bert and I a thumbs up, turn the thumb blue. It takes 3, 2, 1 seconds. Is it blue?
Looks blue to me.
All right, let's get in because we're going to talk to you about a brand new dividend video really focused on what the Fed just completed this past week. I believe Friday, end of day, December 18th. Bert, what did the Fed complete?
Well, the Fed made some major news as they just completed their next round of stress testing with the banks. So to bring it back, every quarter, the banks are required to submit their financial results and plans for stress testing the bank's balance sheet.
And if you don't remember, the large institutions essentially were prohibited from a few items. One being able to buy back shares, aka share buyback, stock buyback, stock repurchase program. There's a bunch of phrases. Insert Bert shaving his beard at some point.
Maybe.
And then they also were limited to the amount of their dividend based on prior net income results, as well as had to essentially, halt dividend increases in a nutshell.
Yeah, and the Fed did this at the beginning of the pandemic as a lesson that came from the financial crisis in 2009 and 2010. This point of the stress test is for the bank to do better planning with their balance sheet. It's to show in good times and stress to show what happens in the extreme bad financial conditions, what can happen to the bank. So when the pandemic hit, they ran their stress tests. And to Lanny's point, they said, let's put a halt on dividend increase, or let's put a halt on buyback so you can make sure you have enough cash to weather the storm.
And in the banking industry, for everybody watching, capital is king. And the Fed did not want the banks to use their capital to buy back depressed shares because of the stock downturn and to give out some of their capital in the form of dividends to their shareholders. And that way their capital levels are up, reducing the risk of failure of a bank.
And that really helped at the beginning of the pandemic when there was so much uncertainty in the economy. Banks, we didn't know how banks' loans were going to perform. They were still figuring out the PPP loan programs at that time. There was so much in flux and so much in question. The move to put a halt to this was probably the right move to preserve the cash and keep it in the system. However, fast forward now 7 or 8 months, we're in a completely different ballgame here.
So the big banks really passed the Fed smell test here. And we're going to talk about 4 banking dividend stocks, really some of the 4 largest banks in the world, let alone in the United States. And we're going to let you know about what each bank now is allowed to do, what the stock market's reaction is going to be when you open up at 9:30 a.m. Eastern time on Monday morning, as well as an investor, not what you should do, but what you can consider on a go-forward basis.
Then let's just jump right in. Let's start with the largest of the banks, JPMorgan Chase, ticker symbol JPM. Currently, JPMorgan has a nice dividend yield of 3%, but the news that took it was the release after the stress test. The board authorized up to $30 billion of share repurchases for the company.
$30 billion?
Yeah, they're not messing around here. So to Lanny's point, when their prices were plummeting during the beginning of the pandemic, you didn't want that $30 billion leaving the banking system and going into shareholders' hands. You wanted it to be there. Now that everyone's a little more liquid with their cash, banks are flushed with cash, we're good to go to start paying back and buying back some of that stock.
And that's $30 billion with a B.
But
a stock purchase program.
Yeah, that's insane. That's a lot of stock for JP Morgan. And it didn't stop there, though. They just announced they're going to keep their dividend in line at 90 cents per share through Q1 2021. So they're going to let things shake out a little bit. But get ready when you start seeing financial statements for next year to see those share repurchases jump through the roof.
So 2 things. One, their dividend's going to be the same over the next 3 to 4 months. And then on top of that, 30 billion shares is going to start being purchased. And when they announced this $30 billion repurchase program, that doesn't happen all at once, and it really just happens throughout the time period that they were approved to have that allotted. And what a stock purchase program is going to do is reduce the number of shares, which does what?
It increases your EPS.
Which in turn usually increases your stock price.
And then it also decreases that dividend payout ratio as well.
Because your EPS goes up, so that means your payout ratio is going to look better, which allows room for
dividend increases.
There you go, Bert said it.
So stay tuned to Q2 2021 to see JPMorgan potentially increase that dividend when all the moves settled down.
In Monday morning, JPMorgan's stock price will more than likely be much higher than where it was on the close of business on Friday.
Dividend stock number 2 is one of the more controversial names in the big banking sector.
Controversy in banking?
Yeah, it takes a lot for there to be controversy in banking in the highly regulated world of the last decade.
But this one definitely has been all over the news, probably in the last 5 years. A lot of negative news, lawsuits, a lot of fines and charges.
Yeah, they went from being one of Warren Buffett's darlings to now one of the dogs in the banking investing community. Dividend stock number 2 here is Wells Fargo, ticker symbol WFC. This one's a little more interesting because they actually drastically cut their dividend at the beginning of the pandemic. They were moving towards an unsustainable dividend regardless, and this kind of just put the final nail in the coffin there for that dividend.
Now, with Wells Fargo, I'm not expecting much from Wells Fargo. Their yield is barely over 1% right now based on their current dividend, and I don't see dividends growing in the immediate future.
No, I think they're gonna stick to their plan, let things level out, let their capital be preserved, and use time to kind of regroup, refocus, and rebuild the company from where it was last year.
Right. I think they have a lot more to prove, over the next 6 to 9 months, and then maybe this time next year, Wells Fargo maybe ringing a different bell heading into Christmas.
Yeah, and this one was a little more interesting because it wasn't just okay. Fed allows you to do as many repurchases and dividends as you want to, like it was for JPMorgan. There are a lot more strings attached to Wells Fargo's repurchase program that's allowed due to some of their issues they had. The Fed will allow them to repurchase shares in Q1 and pay dividends as long as the amount doesn't exceed the average net income for the 4 preceding quarters. So think about that. It's not free rein to start increasing their dividend and start paying money to their shareholders. They still got to make sure they're performing and earning a lot of money along the way.
And the amount of shares that they're actually able to repurchase has a lot to do with where their employee compensation expense is, as well as where their capital levels are. So again, not really this is what Wells Fargo is going to do, but that they've got a lot more strings and hurdles that they need to cross in order for Wells Fargo to start increasing that dividend and buying back their stock.
So Lanny's point before was I don't expect any major news with the dividend anytime soon for Wells Fargo. And you look at those 2 strings attached to this announcement from the Fed, I could not agree with Lanny's assessment more. Not a chance they're going to be increasing that dividend in 2021 in the short term.
So again, Wells Fargo, has a few more, walls to push through. Are they going to be okay? Yes. Are they going to be as talked about with what they're doing as compared to JPMorgan? No. But this is a good segue into banking dividend stock number 3.
Citigroup, ticker symbol C. I love the simplicity of that ticker symbol.
Yeah, you can't get much easier than one letter.
Yeah. Our ticker symbol, well, we can't. D is up for Dominion. So.
Yeah, D and double D is Dow DuPont.
Yeah, we'll figure something out when we take the diplomats public.
Not Dow DuPont, but DuPont.
Dow, whatever they split that company into,
right.
We're still trying to figure that out.
But Citigroup, now they have plans to restart its stock purchase program and to also keep its current quarterly dividend at 51 cents per share right now after the Fed gave them the head nod, tip of the cap to Citi.
So just like JPM, I'd put them in the same bucket. I don't know if it's been announced yet by the time we're filming this, what exactly their board's going to authorize them to repurchase. But learning from what we saw from JPMorgan, I don't expect it to be a small dollar amount. I would expect multiple billions.
They'll be in the billions.
For sure, they're going to be.
I mean, they currently yield 3.45% of the dividend yield for Citi. Again, we like to talk about these institutions because everything they've gone through, there's a lot of safety in that dividend because of restrictions and the stress test that they're doing. So again, that's why we're talking about the yield, because again, their dividend payout ratios are all, fairly sound, as well as the institutions themselves, because they pass these significant and difficult stress tests.
And last, but definitely not least, we are going to head back down to Wall Street for our fourth dividend stock here with some other major news and announcements. We're going to talk about Goldman Sachs, ticker symbol GS. Much like JPMorgan, much like Citigroup, Goldman Sachs is going to start resuming their share repurchase program as well, based on the positive results of this stress test. Unlike Citi, they do not yield above 3%. Their dividend yield is only 2.07% at the time we're filming this. So I don't know when the dividend increases may come in the future, but if there's room to go with the repurchases that are going to start next quarter, we may see another dividend increase coming soon from Goldman Sachs once again.
Again, Goldman Sachs, a player that was increasing their dividend fairly consecutively, like JPMorgan Chase was. So Goldman, to me, is another very solid and sound overall financial institution, and they do obviously a heavy hand in investments, investment managing, as well as in deal projects. Now, when we go through the four dividend stocks here in the banking industry of JPMorgan, Wells Fargo, Citi, and Goldman Sachs, obviously we're not here saying, yeah, go out and buy them now. Don't buy these stocks today. Buy these stocks today. Hold on buying these stocks. But we wanted to at least tell you this big news in case you're exposed to the banking sector, in case you wanted to invest in the banking sector. These larger institutions, again, JP Morgan's, the Wells Fargo's, they are now becoming a little bit more better to hold in your portfolio because of what they're allowed to do.
Yeah, and I think that's huge. It's huge for the banking sector, and I would even take it a step further. It tells you about the broader state of the economy and some of the other dividend stocks that you may own too. Remember, the Fed halted dividends and they halted repurchases because of the economic uncertainty. They didn't want the system to collapse the way it did in 2009 and 2010. We're here at the end of 2020, entering 2021. After months and quarters of stress testing, here we are saying we feel good about the different scenarios. You can start giving some of that cash back to the shareholders. We feel decent enough about the economy for you to engage in that activity.
Personally, I'll probably run JP Morgan through an analysis here soon, as well as Goldman Sachs, actually, just because of where they were beforehand, and the track record that they were building, and the amount of assistance that they did during the first financial crisis, and how they really have stayed out of the news from a negative standpoint.
Excellent point. I'm going to be looking forward to your analysis with JP Morgan. Maybe it is time to buy after we take a look at the metrics.
So what are you doing right now based on the news from the Fed? Based on watching this video, how does that change your opinion about investing into the bank stocks? We're curious. We're seeing, we want to see if you already own JP Morgan, Wells Fargo, if you bought any of them during the crisis.
Yeah. And the other piece too is these are only 4 of the large banks. There are a ton of banks out there, so we couldn't cover them all. We didn't plan to cover them all. If some other of the major banks hold and announce major share buyback programs, leave it in the comment section. Please, drop it down below so we can see what everyone's doing and everyone else who's watching this can learn, maybe see if one of their investments that we didn't cover announced a dividend increase or share repurchase.
And if you enjoyed this video and you got something from it, please give us a thumbs up. If you haven't already, subscribe to our channel. We try to come out with at least 3 different videos every week on a Sunday, Tuesday, Thursday schedule, barring any holidays, because we try not to interfere with the holidays. We appreciate you stopping by. This is Bert and Laney from the Dividend Diplomats.
Over and out.